I have a feeling silver is going to, we start to really outperform gold here. In my opinion, it's a matter of time for us to see the prior highs being taken out.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 30th through October 7th, 2024, while supplies last. First, we feature backdated 1-ounce gold Canadian maples at just $60 over spot. Next, we have 2024 1-ounce Silver Britannia at $3.10 over spot. And finally, the 2024 1-ounce Silver American Eagle is still just $5.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa from Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this.
Well, it's great to have you today. I did want to start off with, I think, the big two topics in the news right now. Obviously, we had the job strike, right, for the port workers along the East Coast there. And then we're also seeing the missile attack in Israel by Iran. So it seems like both of these could definitely have financial impacts, economic impacts, geopolitical impacts. Your perspective on that and how these might impact supply chains, oil prices, and all of that.
Yeah, I think that the inflationary impact of the things you have mentioned are clear. However, is this going to be, like COVID? Those are questions I don't know how to answer. I don't think anybody knows how to answer. If you look at inventories of most businesses, it is higher than the levels it was prior to the pandemic. So maybe, after seeing that, I don't think that things are going to be as dire as we saw back then, but that also depends on if they're going to get into an agreement with the union or not. The bottom line is that this is the foundation of an inflationary era, in my opinion. And that's really because of, it's the cost of living that rises that then causes people to demand higher wages, that, it creates the social unrest and labor strikes. Regarding the geopolitics now, that's just been, what we've seen, I guess, call it 4 to 6 months since the pandemic is that geopolitical risk tends to sort of dissipate and then come back, very quickly in a big way. And I find it interesting that despite being in this sort of trend where clearly, in my view, there's an escalation of deglobalization trends. The price of things like oil remain as low as they are. And a lot of people think that that's not possible to see oil prices going a lot higher. Certainly not my view. I think that that's a real inflationary risk to the economy. I think that what we have currently in terms of the supply and demand dynamics and the whole thought that Trump coming in or even the Democratic Party staying in would change potentially the production profile of companies. I think we tend to forget that it's, these companies are also limited, especially how much capital they have spent over the last years in terms of CapEx to develop new resources. It's going to limit the amount of increasing production we could see on the back of those factors. And so that's why we're seeing oil prices rise. That's why I think that we're going to see a lot higher, even natural gas prices are, in my view, at a bottom. And those things are going to be really important. Copper has been making a turn as well. And so all that is adding to the inflation front in a big way. And the Fed is cutting rates. The Fed is cutting rates in the midst of all this too.
Now, you've mentioned recently that inflation, it's not going away anytime soon. And we've talked about this before, how in the 1970s, there were different waves of inflation. And we may have only seen the first wave where the second and third might be coming here soon. So your perspective on inflation being structural, why do you think that?
Well, I think there's a notion that inflation is not an issue anymore from market participants in a lot of ways, just because they tend to look at CPI, but that's not the real world. The real world is that people are they're also constrained on their spending because everything has gone up in prices in a very significant way. And those prices have not returned to levels pre-pandemic. In fact, they're going higher. And particularly the things that really matter, food and housing and others. And so if we are living in a world like that, the structural side of this issue is that it tends to cause the consumer to change the way it addresses its financings. And so it changes also how people tend to spend their capital in different things. And so you tend to see savings in different aspects and demanding higher wages. And all these things are critical changes in the whole landscape of the macro setting. And so that I think a lot of people in the macro, now I shouldn't say macro, but in the investment world are sort of missing because they're just so fixated on CPI and PCE and other things, which matter from a policy standpoint. So if you're fully analyzing what the Fed will do, yeah, you should be looking at these things too. But at the end of the day, you have a Federal Reserve that is constrained too, and a Federal Reserve. Sorry to use that word so many times, but a Federal Reserve that is trapped, that is not able to raise rates. Despite having a structural inflationary problem. And that's really because of the cost of the debt is eating into the spending of the government. I had a good chart that I put out in our letter recently that basically shows that about 55% of the fiscal spending today is not pro-growth anymore, right? It's interest payments, it's entitlements, and that's the highest number in 40 years. So you got to stop and think, well, is this starting to creep into growth? What are the possible, policy changes to address the fact that majority of our capital is going to non-growth and non-productive spending? And the only way, in my view, is two things: is you suppress rates, one, and that will reduce interest payments. Interest payments is to that 55%, 20% of that is interest payment alone. So, okay, well, that's a significant amount that can be, reduced if we cut rates. That's what the Fed is doing. Or number two is increase spending further, take the deficit even higher. But we already have a twin deficit, which when you add the imports and trade balance, I should say, in the current account, you're already running a 10% of your GDP on a twin deficit right now, which should hurt the dollar. I know a lot of people say, well, the dollar, the cleanest dirty shirt. Yeah, it used to be, and now we're running a twin deficit of double digits. We have interest rates that are way higher than everybody else at this point. So we got to adjust, and I shouldn't say interest rates, I should say interest rate payments relative to GDP. And so those adjustments are likely to have major implications in the US dollar versus other fiat currencies, not only versus hard assets. So I'm actually very bullish and very constructive on emerging market currencies right now. I think that they can do very well on the back of this scenario.
Now, when it comes to the general stock market, I know you're concerned about it being significantly overvalued. You recently wrote in one of your investment letters that the AI euphoria and the Magnificent Seven present one of the biggest downside risks to financial markets and the economy today. Can you expand on that?
I think that that's just the mania, behavior we're seeing in markets caused from the excitement of some of those technological advancements, which are exciting indeed. They definitely add potentially to the productivity side of things, and I think there will be a lot of new businesses that will be created on the back of these things. But just like the internet, these things take time to kind of really work towards progress and in creating value overall. And I think the difference between this technology versus the internet momentum or the internet phenomenon was the requirement of capital spending is drastically higher here for the infrastructure to be in place to allow these companies to, to do what they need to do. And so this is why you're seeing utility companies to lead the way to the upside relative to any other sector in the economy. The most defensive sector of the economy is leading the S&P 500 performance on a sector base. So either that means there's weakness ahead or all the capital is going towards that. Not all the capital, but a very large percentage. And that's unusual. That's just unusual to see that type of infrastructure. And if that's right, if it's, forget about that being defensive, it has nothing to do with this, okay, then that's extremely bullish for metals, because that means construction spending is going to go to the roof. And it's been going to the roof, but it's going to go a lot more because equity performance is leading that. In other words, institutional capital is going there, which means at some point it's going to create and it's going to allow these companies to actually, the utility businesses, to invest more and more. As we see that, that could create upside for the demand of materials and ultimately should drive metals. And so that side of it is extremely bullish, in my opinion, and something to consider. But yeah, I'm concerned about valuations. I've been concerned about valuations for some time now, and I think you have the yield curve, steepening is a big risk. You have what's happening in labor markets is a big risk. There are cracks everywhere. You have what's happening with the consumer, being under pressure more and more. I think that's a big risk. And now you can throw, the elections and all sorts of things that are also there. And I think the complacency factor to me is the biggest concern, is looking at VIX and credit spreads, and all these things are clearly not in line with the potential we could see in terms of upside for risk. And so I'm concerned about those things. I think that it worries me to pay the price of an asset that is inflated. And to me, that's what it is buying US stocks today.
Do you have any concern that if we do see a crash in the stock market, that it could take precious metals down with the stock market could take precious metals down with it?
I think it's possible. It's, I think you don't want to be too cute on those fluctuations in markets, but a lot of people like to talk about '08 as an example, right? '08, gold prices declined initially and then went up a lot. But that's not the only scenario we saw. I mean, the early 2000s, the miners went up when the tech bust was still developing. In the 70s, we also saw the miners going up. I mean, that would be unthinkable today, right? I mean, who would make that call and say, hey, miners are going to go up as the market crashes? I don't think anybody would agree with that today. I love the contrarian views on those things. I don't know if it's going to happen, but it's something that nobody agrees with, right? I mean, I don't know of anyone really, pounding the table saying miners are going to go up as the equity markets go lower. So that's, those are interesting ideas. My view is that, I've always think on a pendulum perspective. I mean, if things have, really gone very far on the pendulum in terms of valuations in equity markets, so how much can we fall on that front if we see a real reckoning moment? A lot. And how much can we see a fall in metals and other things that are historically undervalued? Probably not a lot. And so from a relative standpoint, I find it attractive to still own those things. Now, do I think gold has got slightly ahead of itself recently? Yeah, I do think so. I think gold had a big move. I mean, most of the even more technical indicators are showing that has been quite the move for the metal. Now, does that mean that we can see a large correction? No, it doesn't mean that. Doesn't mean we're in a bubble or anything like that. But we could see a consolidating period before another big move, and that would be just normal. That would be hopefully very healthy as well to kind of take away a little bit of this expectation that gold prices will only go up from here. And gold prices can fluctuate too. So I can see that happening here. I know we're seeing a down day today, and I think that could be, we could easily 5-7% declines on the way up, and that's just normal part of the game. Now, silver, I have a different view. I think silver is definitely performing even better than gold more recently. I have a feeling that silver is long overdue for a big move. I have a feeling silver is going to start to really outperform gold here moving forward, and I'm of the view that this could be very interesting for silver investors, because it's, in my opinion, it's a matter of time for us to see the prior highs being taken out, and so I think we're getting close to something big here.
It does seem like silver is kind of lagging here. It's still nowhere near all-time highs. Gold is, has risen 30% from the 2000 levels. So what kind of target do you see for silver, maybe by the end of the year, or, the very short term here?
I was looking at compliance reasons. I can't share actual prices of where I think it's going to land, but you can kind of see where the prior high was and think where I'm trying to, rationalize where it could go. But if you look at the silver price behavior versus gold adjusted for CPI, I know people are going to say, why CPI, Tavi? But it is interesting. You just got to say that it's interesting, at least, that they follow each other exactly the same. Like, both have not taken out their prior highs, and they both have this massive cup and handle on the chart. I find that interesting because I myself, and I think everybody that follows precious metals, tend to say, well, silver is the more volatile version of gold. And it's true. But it is interesting as well that silver is almost like gold adjusted for inflation in a way. So I find it a interesting way as well to sort of think of the metal in that front. But I do think that cup and handle is real, that massive cup and handle, and it's one of my favorite technical formations. A lot of people overlook that because it looks so simple and unrealistic, just because it looks so simple. And in Wall Street and investments, we just tend to overcomplicate things. But I think actually cup and handle formations make a ton of sense historically. And even if, and I don't want to go into this, but even when you think of your own life, your first decline in life, your first decline in the first dip professionally, for instance, or personally, can be a bad one. Your second one will probably not be as bad because you're more prepared and it changes how your behavior would be under the same level of pressure you had before. And so I actually think cup and handles psychologically make a lot of sense. And again, not to get into that too deep, but if so, I think we're going to take the prior highs in silver. I think we're going to take the prior highs in gold adjusted to CPI or inflation. And that could be really interesting. Now, I mean, keep in mind, I'm not saying CPI equals inflation here. I'm just saying that we just haven't seen that measurement. And for investors who actually put money into things in general and deploy capital, CPI does matter, right? I mean, that it can move policy, it can move a lot of things. So despite the fact you may disagree with the calculation, you have to consider as one of the macro factors on your side to understand the market. And so I actually disagree with a lot of people that just ignore that. If policy making has such a high relevance to that metric, you have to at least consider. You can put a lower weight, I do, to that significance of that index, but it still is relevant. It still should be used as part of your research.
Kind of stepping back here, looking at the big picture again, I did want to get your perspective. Maybe if we see a continuation of these geopolitical conflicts, then do you see that just being good for gold, or over the long term, does that not really have much of an impact?
Well, I pay very close attention to the market reaction when you have those big moves. You know, big headline, and you've got all markets. You know, Nasdaq down 2% on the day of that, and or on the few minutes after the headline was released, and all sorts of things happened. Oil went up a lot, and then you had the dollar rally. And then you had treasuries rallying as well. So in other words, 10-year yields especially was falling. And those big days, those big moments geopolitically usually mask a few movements in markets that are not usually right. They're usually just doing that for a day, and then we tend to see a big reversal on those trends later on. The way I view how this is going to unfold is that I think that the indicators that were essentially lying that we're probably going to see big changes ahead because of this impact on geopolitics is that the 10-year yield is likely to go a lot higher, in my opinion. I would put a lot of conviction on the view that long-term yields are poised to move higher. This is just my opinion, 10-year and 30. I think that because of how the Fed is strapped, the steepening of the yield curve is likely to accelerate as well, even further. I've been of that view, and I think that what happened yesterday only adds to that view. And guess what happened with the steepener? It was actually going the other way. It was flattening yesterday. So that's not my view. When I saw that, I immediately told internally here at Crescat, I said that's not a real move. This is one of the things that you see in those shocks, and people just immediately try to react. But that's not a real move. There are other moves that will come out of this outcome that are even more relevant, and one of them is inflation. So oil was real. Like how can you justify oil going up 3-4% on the back of yesterday's news, and then 10-year yield falling, right? I mean, think about this long term, not today, long term. Oil is going up. That's inflationary. That oil and break-even rates, which is inflation expectation, which basically is a calculation of the market in expecting what CPI will look like in the future. If you're a market participant, people really look at break-evens. Break-evens in oil is the same chart, especially more recently in the last few years. So if you think oil is the beginning of a move, then inflation expectations is probably going to do the same. And so maybe, you can extrapolate that further and say, well, the 10-year yield also looks really, poised to have a big move. And why the 10-year yield? Why the 30 and the 10? Well, we know how much issuance is happening on the supply front. So if you also have on the back of that a market that has, so 10-year yields have fallen quite significantly recently in the last few months, and they are technically, oversold. They had a big move on the yield basis. And so they're likely to start moving higher, in my view. I think elections will only add to that in a big way. And the union and the labor strikes we're seeing, and all these things are going to add, in my view, to 10-year yields moving a lot higher. And so I'm paying very close attention to that because it's definitely a high conviction view.
All right. And if our viewers are interested in continuing to track this with you, they can go to crescat.net. Can you share with our viewers what they'll find there, and also any last thoughts you had?
Well, thanks for having me. First of all, they will find a letter. I put out a recent letter here talking about some of these dynamics with non-productive spending in the U.S. versus what is pro-growth spending. I don't think there has been enough conversations about this. And there has been a lot of conversations about interest payments and all that, but like how much of that is starting to actually drain how much is spent on growth? And I think that has major implications in the U.S. economy. When I think about what's the biggest factor that caused the U.S. to be at a higher growth than other either developed economies or the rest of the world, you can see this on equity markets easily. Valuations are much more inflated here than elsewhere. One of the main reasons is fiscal exceptionalism, is that the U.S. as a reserve currency status, or the U.S. dollar as reserve currency status, allows the U.S. government to spend more than others, be less disciplinary. And that happened on the back of how much is spent on fiscal spending relative to GDP versus other countries. So if you look at that over the years, the U.S. has spent a lot more than other countries. And those are, majority of them, believe it or not, are pro-growth spending. If you're starting to see that shrink relative to other countries, what does that do? Should that have an impact on the differential of valuations of U.S. companies versus other places in the world? I would say yes to that question. And so I'm focused on other countries, and that letter that I just mentioned will go deep into some of those thoughts, and hopefully it was the rationale is clear, but that's basically the idea. But anyways, thanks for having me. I appreciate the interview. Hopefully I offer some interesting ideas to your viewers.
Fantastic. Well, we always appreciate your time, Tavi. Again, it's crescat.net. We'll put a link in the description of this video. Thank you so much, and God bless.
Thanks for having me.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 30th through October 7th, 2024, while supplies last. First, we feature backdated 1-ounce gold Canadian maples at just $60 over spot. Next, we have 2024 1-ounce Silver Britannia at $3.10 over spot. And finally, the 2024 1-ounce Silver American Eagle is still just $5.25 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.